Hi, Chris Duff over at Serious Land Capital Vacant Land Funding Partner. So today I wanted to discuss a bit more about possibly acquiring active deals, particularly as it relates to existing double close situations. So I just had commented a bit about this in the last Land Daily Diligence session, but because it shows up so commonly, I just wanted to elaborate a bit further here. Double closes have become more popular across the land industry. Things get more competitive. There's want more money for their deals. Deals get bid up more routinely. So, we're well aware that a lot of land investors have shifted. Okay, going to offer more, try to get novation contracts going, see if you can double close accordingly. I mean, it's a fine strategy as long as you can uh, make it work. And we've handled a lot of transactional funding associated with these deals as well. You can get it stuck in between a rock and a hard place, though, when the seller decides they might want to close earlier than expected, or you start running out of time on your novation contract. And, reputation is always a risk here. You're trying to price properties properly to still get the seller what they're looking for and still earn your nut on top of those proceeds that are going to be distributed. But yeah, when you run into those situations where you're running out of time, not able to get a seller in line, and again you've got potential closing timelines that need to be accounted for outside of what might be on your novation contract. So even if you do get potential backup funding or you find a way to close a deal, that's going to take some time to potentially close with the title company anyway. It's possible you might have done some work on it initially. Usually that would be the recommended case, just to ensure you're not trying to sell anything that hasn't been vetted appropriately. But again, you can risk trying to sort that out just on a B2C buyer case and sort out the title there. But again, it depends how much risk you might be willing to take before putting a property on market. So that's just something to keep in mind in relation to whatever closing date you have set with your seller. So it's not like you can just immediately turn around and close on a property when you have a date coming up. So that's why I know a lot of folks will recommend on those novation contracts, giving yourself close to 180 days generally. Usually I see 90 days to be the least amount, but I've definitely seen less because, again, we've gotten a lot of these crunches that have come our way more routinely over the past several months. So let's jump into that scenario then where, you're running out of time or seller just is getting cagey. They want to get out of the deal earlier than the date, and you're losing rapport by the day, starting to feel the pressure. Then investors will come to us. Okay, can you equity fund this deal? We think that it's going to sell for X amount. It's already listed, getting a lot of activity, etc. Here's what the margin is, what we need to pay out to the seller. Can we move on this? Every situation is different, of course, but more often than not, I'm extremely hesitant to jump into those situations with a lot of overlapping reasons, like when I had discussed the other day about just buying actively listed properties, but active on behalf of the seller, not when you're trying to double close on a property. So if a property was listed within the last 5 days, perhaps, and was already getting a lot of activity, I might be more inclined to consider, okay, this is realistic that we could exit for whatever this price, track up the margin based on what the proceeds need to go back to the seller. and we can see what we have to work with there. But again, it's always cautious because, equity funders, we come in, generally would want to be buying no more than 60% of conservative market value price, depending on the market. Probably the higher value of the deal, the more conservative I'm going to be. And if you have a double close set up, usually your margin is going to be more constrained than that. Otherwise, it might have made sense to just purchase the property outright. So already we're probably going to be in a tighter margin situation anyway, even if you have a lot of activity on your deal. So, I've seen some investors come back and they might say, hey, we're going to be able to sell this for this amount to Y amount range, but they're only listing the property at that X amount, the lower amount. So if I'm seeing something like that, well, I'm not going to assume that we can sell it for more than that. Otherwise, it probably would have moved right away. Like, again, quality properties, they will move quickly. Price is the primary determinant on marketability. Even if we could have improved your marketing and so forth, photos, listing description, etc., a better quality broker, I'd say all of those factors are probably worth maybe 5% of the potential marketability of a deal. Like, price really drives almost everything, and price combined with characteristics, but that should always go into what your initial pricing analysis was when you first put the property on the market. So, barring some activity within the first few days of listing a property and you're already in a crunch, but if something's already been listed for more than a week, 2 weeks, close to a month, and it might have a lot of online activity, maybe a lot of window shopping, but the next question I'm going to ask, okay, have you gotten any site visits, any offers, even any lowball offers? Like, do we know what a real floor is for this property? Could we exit this thing now? By the time a property is listed, and I know I remark on this constantly, like, the active listing is by far the most important data point. We can comp out the area plenty of times, but if something's active, that is going to be driving most of our underwriting decision making when it comes to that particular property. Like, most of the times I see active listings, I'm really not even considering other properties in the area, because I can make a lot of decision making just based on what the activity is for an existing active listing. So usually I'm going to want to undercut that, again, outside of a situation where it was like just freshly listed and might have already gotten some calls. Like, if it's gotten some offers and so forth, then great, we might be able to make some decisions off that. But yeah, if it's already been 2 weeks plus on no site, or site visits can be somewhat important, but no offers by then, the more days on market, the harder this property is going to be to sell, and less likely at that price that it's currently listed. So we want to undercut accordingly from that. And again, might already be constrained on margin anyway with the sellers, so we might even need to try to negotiate to get them to take it down. But that's going to be in a rare case for them to accept, because you had already promised them a certain number with the novation, then it got tight, and they're probably not going to be the happiest, especially if you ask them, hey, to reduce the price right at the last minute. Like, that rarely works. You got to be really cautious before getting into these situations, but things happen, and try to save things when you can. But I'm just remarking from an equity funding perspective why it's so uncommon that we'll pursue these. And as the last point here, recall too, is that even if we buy the property, and even if we utilize the same broker, that property needs to be taken off market and then relisted anyway. So that's a massive black mark on the property on behalf of other buyers who, if it's been up for longer than a couple of days or so, a lot of prospective buyers already have seen it, and they see, oh, wow, this property was just purchased and now trying to be on sale again. What just happened? Is something wrong with it? Buyer just got cold feet immediately, maybe for the same pricing, slightly below. Just put yourself in these buyers' shoes, and and realize that you've got a lot of hair that you suddenly just put on this property that's going to have to be overcome, and why we probably want to undercut even further on that buy price to account for the negative impact of the marketability when we're buying active listings. So word to the wise, extreme caution when it comes to purchasing active properties or trying to seek funding and saving a double close situation with equity funding or even debt funding. High risk scenario, hard to make work. Hope this helps. SeriousLand.capital for any of your funding requirements for various deals. Tons of activity this week. Few fires to put out, of course. Title companies, more stories about that shared shortly. Land Daily Diligence for zero cost review of your land deals, and landpricer.ai for the most simple and accurate way to price land. With that, take care, everybody. Bye.